Today's highlights. Bitcoin looks steady on the surface, but underneath, short-term traders are cutting each other down. Altcoins struggle to rebound, Grok takes on office, and a celebrity wins a lawsuit over a rug pull token. With the market in chaos, how can retail investors protect themselves? We'll explain it all tonight. Watching this could save you hundreds of thousands. Reshaping value with digital assets, tracking 24-hour crypto trends, and elevating wealth through insight.
Monday, April 20th, BitcoinTV Chinese channel. Where's the blockchain heading? I'm Mai, filling in for Michael again today. Our daily reports cover Vietnam, Japan, Korea, Thailand, Spain, and English-speaking regions broadcast by local anchors. First, let's look at the top 24-hour crypto data headlines sponsored by NEXO. NEXO is a licensed, compliant crypto platform now available in Asia. It's more than just an exchange. They help major Asian clients manage digital assets through holding, staking, lending, and spending, all while staying compliant. Scan the code for fee discounts and a $5,000 deposit bonus. New users who deposit can use their UID for our Sunday live draw, with prizes up to 1,000 VU. Bitcoin is currently around $74,871. It's down 1.19% today, but up 5.19% this week. It looks stable, but the capital structure has shifted. Of the 7,006 Bitcoin flowing into exchanges in the last 24 hours, 99.23% are from short-term traders. Long-term holders account for only 0.77%. In other words, the current selling is almost entirely short-term capital. Crucially, 88.93% of the $20.5 billion in trades happened via OTC. Only 11.07% was on exchange. Coinbase's 45.54% share even topped Binance's 40.28%, showing US capital still dominates spot trading. Looking at Binance deposits, 98.92% is short-term money moving in and out within a day. This clearly shows short-term speculation. Long-term holdings are unmoved, expect volatility, but the real sell-off hasn't arrived yet. Altcoins are still in a recovery phase. Since the October 2025 peak, total 3 market cap vanished by $460 billion, a 38% drop. Despite a $90 billion bounce since February, it's only a minor recovery. The data is clear. In early February, 89% of altcoins were below the 50-week moving average. That's now 67%. Some are recovering, but most are still down. The 50-week line is the long-term life or death mark. With 2/3 still below it, this isn't a bull market return, just a slow repair. With nearly 49 million types of coins now, capital is spread thin. Investors are flocking to a few major assets, making a broad altcoin rally unlikely in the short term. The direction of AI in the workplace is shifting. XAI has launched a new version of Grok. Its goal is straightforward: to reinvent the entire suite of tools like Word, Excel, PowerPoint, and PDF, directly competing with Microsoft Copilot. This update isn't just about chatting and writing content, it dives straight into core workflows like document processing, data analysis, and file collaboration. There's only one core change. AI is evolving from a tool into a gateway. You're no longer just using AI, you're completing your work within AI. The next competition won't be about who writes better, but who can dominate the Office gateway. If Grok breaks in, it won't just be rivaling Copilot, but the entire Office ecosystem. Our program is broadcast daily in Vietnam, Japan, South Korea, Thailand, Spain, and English-speaking regions, synchronized by local anchors in their native languages. Let's take a look at today's content. An investor named Lee Greenfield bought the Jenner meme coin, which Caitlyn Jenner was involved in. Jenner is a former US Olympic champion and a longtime media figure. The token caused him to lose over $40,000 while trading on both the Solana and Ethereum chains, so he sued, claiming it's an unregistered security. However, Judge Stanley Blumenfeld Jr. of the U.S. Federal Court in California dismissed the charge. The key to this dispute isn't the price fluctuation, but whether the token legally constitutes a security.
Jenner is a celebrity-branded meme coin launched in May 2024 via Solana's Pump.Fun and was later reissued on Ethereum. The structure of having the same name on different chains led to split liquidity. The plaintiff, Lee Greenfield, participated on both chains and argued that the version switching and constant promotion worsened information asymmetry, causing value dilution for early holders.
From the plaintiff's perspective, the issue is more direct. He believes he bought in based on Caitlyn Jenner's endorsement and related promotions, including content on X and expressions implying gains, resulting in an actual loss of over $40,000. This is also why the case has garnered so much attention. The loss clearly occurred. The dispute centers on whether such influence constitutes legal liability.
The core of the court's review is the Howey test, with the key sticking point being the common enterprise. Although the plaintiff bought the coins, he failed to prove that the funds were managed collectively or that the returns came from the same project. Simply put, everyone buys their own coins and bears their own risks. It's not considered a joint investment. Meanwhile, the 3% transaction tax, promotions, and buybacks weren't seen as tying interests together, as the project earns from trades while investors earn from price increases, two different paths.
What this case really clarifies isn't whether meme coins are securities, but why this specific structure fails to meet the criteria for being a security. Celebrity promotion, market volatility, and investment losses all exist, but in a legal judgment, the key factors are whether there's a common enterprise, a pool of funds, and shared profits. Since these core elements weren't fully proven, the path to applying securities law is very difficult to establish. Why can't this case be prosecuted under securities law? Now, a more practical question arises. If it's not a security, does that mean the project team has no liability? Actually, no. The court only blocked the path of federal securities law this time, but issues like fraud, misleading, and quasi-contracts weren't ruled non-existent. They're just outside this court's jurisdiction for now. In other words, the most direct path for rights protection via securities law is blocked, but the liability itself hasn't vanished. For investors, securities law was the most direct protection. Once deemed a security, the project team must handle registration, disclosure, and sales liabilities. But the Jenner case shows that these meme coins are hard to fit into this framework, making it difficult to apply these rules directly. More realistically, this structure has already become a standardized business.
A promoter named Sahil Arora was accused in 2024 of mass operating celebrity meme coins, first contacting celebrities to launch them, then cashing out when prices peaked. Caitlyn Jenner, Jason Derulo, and Rich the Kid were all named as having participated in similar schemes. Take Jenner, for example. When the market cap hit $30 million, he sold everything at the peak. The whole process is like a standardized arbitrage flow.
I woke up, I sold immediately at 30 million market cap.
Another key point in this case is the 3% transaction tax, which the plaintiffs linked to promotion, buybacks, and marketing activities. While this part wasn't tried under securities law, the flow of funds and whether promises were kept often become the core of subsequent disputes.
So what this case really stalls isn't whether there's a problem, but how to hold them accountable. Once the securities path is closed, they must turn to other routes, which are inherently more complex and costly, significantly raising the bar for average investors. Let's take a step toward reality. Can celebrities actually launch meme coins? Well, just look at the current market and you'll see.
Besides Caitlyn Jenner, singers like Iggy Azalea have directly launched their own meme coins, like Mother, driven by community and traffic. Rapper Soulja Boy is more involved in promoting and endorsing various tokens and NFT projects, and even someone like Jack Dorsey has explored on-chain assets and ecosystems.
If you break it down, there are really only two types of celebrity coins. One where they're personally involved and hold the tokens, and another where they just endorse it without direct ties to the profits. Caitlyn Jenner falls into the former category. The deeper the involvement, the greater the controversy once the price starts to drop. The key isn't their identity, but their actions. Once they start using their platform to pump up market expectations, the capital starts flooding in. This model isn't just for celebrities anymore. Even politicians are starting to cross that line.
In January 2025, a Trump-related token launched 3 days before the inauguration. Its market cap hit $27 billion in 2 days, then plummeted about 96%. On-chain data shows only 58 wallets made over $10 million, cashing out about $1.1 billion, while 764,000 retail investors lost money. The team then announced that the top 220 token holders could attend a White House gala dinner. Following the news, the price jumped about 50% in a short time, immediately followed by a massive sell-off. This design is essentially using the influence of one's identity to directly drive trading.
He creates demand by essentially opening a channel for bribery. If you buy his coin, the price goes up and he makes more money. If you buy his coin, you get secret access to the president to be able to plead your case, to be able to ask for preferential treatment.
So the question isn't whether they can launch it, but what this model is actually doing. Essentially, it turns influence into a trading gateway and attention into liquidity. As long as capital is driven by emotion and expectation, the risk doesn't vanish. It just shifts from price volatility to the structure itself. Finally, let's look at what real changes this case has left on the market. It's quite direct. When a structure is proven hard to classify as a security, it gets copied fast. This gives projects room to move, but for the market, it means rules are loosening.
The Jenner case sent a clear signal. As long as you don't design profit rights, pay dividends, or set up clear capital pools, it's easier to avoid being labeled a security. This leads future projects to favor weak structures, downplaying returns while amping up narrative and emotion. It's essentially using structure to evade regulation.
The problem is that these assets have full financial attributes at the trading level, but lack corresponding constraints at the regulatory level.
These tokens can be hyped, pumped, and dumped just as quickly, creating real gains and real losses for those involved. Yet, in terms of legal classification, they don't fully fall within the securities framework. The result is a mismatch between trading activity and regulatory oversight. The market is moving, but the rules can't keep up. As more projects take this path, the risk no longer comes from a single project, but from the entire structural framework. Once capital flows rely primarily on emotion and influence, volatility is inevitably magnified. And without proper constraints, this model is far more likely to lead to cyclical harvesting of investors.
So the real signal this case sends isn't that meme coins are safe now, but rather that when influence, sentiment, and capital form a closed loop, and the law hasn't fully caught up, this space will just keep on expanding. Once it's proven to work, we're only going to see more and more projects like this.
BitcoinTV is back on the official list. Bitcoin2026 just announced its media attendees, and we're right there in the same row as Bloomberg, Block Tempo, and Be in Crypto. This is already our third invitation, following Hong Kong and Dubai. To put it simply, we've always been in this circle. This is the third consecutive time we've been invited to this summit series after Hong Kong and Dubai, staying right in the heart of the global Bitcoin communication scene. As soon as the hackers struck, Aave was spooked into a $66 billion outflow. Half of that was stablecoins. Lending rates even spiked to 15%, and the market flipped from bull mode to panic mode in an instant. Polymarket is looking to raise another $400 million, pushing its valuation straight to $15 billion. The prediction market hasn't even finished betting on the results yet, but it's already placed a big bet on its own future. Layer Zero has come out and said this attack looks like it might be North Korea's Lazarus Group. The issue was a single sig setup controlled by just one key. Security became a single point of failure. This whole thing was basically like having a built-in backdoor. The Kelp DAO cross-chain bridge got hit hard, with losses around $292 million. Over 110,000 RSETH were drained, and the hacker cashed out about $250 million. This wasn't just a bug, it was like an ATM just opened up for them.
What we've always focused on isn't just reporting the news, but breaking down the structures to see the core essence. If you find this logic helpful, make sure to follow us and turn on your notifications. And if you're looking for something even deeper, our advanced channel is ready and waiting for you. From Monday to Friday, I'll walk you through a market review to find those high-certainty opportunities within the trends. I'll see you tomorrow. That's our deep dive for this episode. Our channel remains dedicated to the core narratives and uncovering value within the digital asset space. If you resonate with our logic, feel free to stay updated with our latest insights and enable real-time notifications. To access a more in-depth research and analysis space, you can follow our advanced channel. From Monday to Friday, I'll share my personal deep dive into market cycles to help you capture high-certainty opportunities within the trends. See you tomorrow.